The Bureau of Labor Statistics last job report found that state and local governments have already laid off nearly 1.5 million public workers. If Congress doesn't act soon to help state and local governments, they're going to have to cut life-saving services, lay off or furlough more teachers, public safety, emergency health personnel, or raise taxes. So, Dr. Spriggs, let me ask you, if state and local governments continue to lay off workers, will that create a substantial drag on any economic recovery?
It will be a very substantial drag, and that's the headwind we face for the final 2 quarters of this year. And it's, again, dangerous for our economy. State and local government helps to support so much economic activity. And even if they don't cut more people, their cut in activity will hurt local businesses. But the number you cited is bigger than all of the jobs lost in state and local government during the entire Great Recession. These jobs aren't going to come back quickly. They're not going to bounce back unless Congress steps in to help state and local governments. The lesson learned from the Great Recession, unfortunately, at the state and local level, is that austerity is the wisest policy because Congress refuses to bail you out. If we have a national macroeconomic event, Congress ignores the problems that state and local governments face. So if you're a governor or a mayor, you will cut expenditures and you will be slow to reinvest. And we can't afford that. We need them to continue investment in K through 12 education and higher education, and as we see in our public health system. So we need them as active partners. Slowing them down threatens our economy tremendously.
Thank you. Mr. DeBoer, what would the impact be on the real estate industry if states, cities, counties had to cut investments in infrastructure and education, public health, safety, raise property taxes to continue paying for essential services?
Well, it would be, thank you, Senator, it would be bad. I mean, real estate and state governments, infrastructure are all intertwined. The health of real estate is critical to the local government's health, and the health of state and local governments are critical to real estate's health. So we're intertwined. And I maybe you were interrupting. I also wanted to say, because commercial real estate employs so many people, real estate employs so many people, it pays so much taxes. In many cases, around 70% of local budgets are derived from revenue from commercial property taxes or transaction fees. As our marketplace deteriorates and can't get credit, and the tenants in our business deteriorate and can't get credit, that will put more pressure on what you're rightfully flagging for everyone is already a problem. And it could get worse as tenants are unable to pay rent, as landlords are unable to make debt service, and as values drop.
Yeah. And of course, in the real estate industry, the quality of life or the work environment is critically important. And these services go to the very essence of that in terms of adding value to where real estate property is located and what they can demand for price. Isn't that fair to say?
Absolutely fair to say. And I would add to it, given the current situation and the world we live in now, how states are able to help keep their transportation systems clean and healthy so that workers feel confident going to and from their place of business and so forth is very, very critical. And that's an added expense for state and local governments as well as businesses, by the way.
Dr. Spriggs, let me ask you, many of us have been disappointed by the ineffectiveness of the Fed's municipal liquidity facility. It would be a massive policy failure if we fail to get money into the hands of state and local governments, as we've just discussed, especially those who are the very epicenter of fighting the virus, which is critical. Currently, loans under the municipal liquidity facility would have to be paid back within 3 years. Wouldn't you agree that just like in the Great Recession, the fiscal pressures on states and localities are probably going to still be there several years beyond that?
Yes, the maturity on those loans has to be greater to really provide the smoothing of income that the state and local governments need. So extending the maturity and lowering the fees. The Fed is putting too high an interest payment on state and local governments through that facility.
Thank you. Thank you, Mr. Chairman.